especially in this part of the halving cycle, there's a pretty asymmetric reward for holding Bitcoin.
Hello there from Bedford, the Bitcoin mecca of the world. How are you all? Welcome to the What Bitcoin Did podcast, which is brought to you by Kraken, the best place to buy, sell and trade Bitcoin. I'm your host, Peter McCormack, and today I've got an interview with macroeconomist Lyn Alden, where we discuss why a currency devaluation is likely. But before that, and before I tell you about my amazing sponsors, I do just want to recommend the first in a series of shows, which has just been released on my sister podcast, Defiance, where we look into Ghislaine Maxwell, the girlfriend of disgraced financier Jeffrey Epstein. That is available at defiance.news now from my amazing sponsors. So first up, we have Casa, who are the best in Bitcoin security. With Casa, it could not be easier to protect your Bitcoin from hackers, personal mistakes, in-person attacks, device failures, and so much more. And I twisted their arm to run a competition, and they are going to give away a 1-year platinum membership for their Bitcoin multi-sig security solution worth $1,800. For your chance to win, you just need to register your email address at keys.casa/whatbitcoindid and join their mailing list. The winner will be announced tomorrow. That is September the 23rd, and that is keys.casa/whatbitcoindid. Also, if you are interested in checking out their products and improving your Bitcoin security, then head over to keys.casa, which is keys.casa. Next up is my other sponsor, sportsbet.io, who are the best in online gaming. And you might have heard recently, with the return of the Premier League, that they are sponsoring Southampton, and they have put a Bitcoin logo on the front of the shirt. Well, they haven't stopped there. They've also just announced that they are the new betting partner for Arsenal. They are really pushing Bitcoin out there to football fans. And with football back on the TV and the Premier League back in full swing, Liverpool with 2 wins under the belt, it is time to get out there and put a wager on your fave team. And sportsbet.io have promotions for all football fans. Just head over to sportsbet.io/promotions, and Sportsbet is sportsbet.io. And also, it's great to welcome back Least Authority as a sponsor for the podcast. Now, this one is for you techies out there. Those of you who are creating the applications. Least Authority is a security consulting company pushing the limits of how to build privacy-respecting solutions. They specialize in security audits, design specification reviews, and security by design. They can help you improve the security of your wallet application, key management solution, layer 2 protocol, P2P network design, use of cryptography, and so much more. Would you like to boost your security strategy? Well, you can arrange a no-obligation call to find out how Least Authority can help you on your next project. Just head over to their website and hit the schedule a call button. That's at leastauthority.com, which is leastauthority.com. Okay, so onto the show today, and I have macroeconomist Lyn Alden. Now, a few days ago, you might have seen a tweet from Nick Carter singing Lyn's praises and linking to her article, A Century of Fiscal and Monetary Policy, Inflation versus Deflation. Now, I read the article, actually I read it twice, and while parts of it stretched my understanding of economics, I did finish it understanding why a currency devaluation is likely. So I reached out to Lyn. I said, come on, do you want to come on the show? Do you want to discuss this? Do you want to make this easy for people like me to understand? And in the article, Lyn talks about debt cycles, monetary and fiscal policy, while looking back over the last century for examples of how these cycles tend to play out. It's brilliantly written, and I've included a link to it in the show notes. I also recommend signing up to Lyn's premium service. I've signed up. I'm really excited to start receiving her write-ups about what's happening with the economy, and as Nick said, there probably isn't a clearer macro thinker out there right now. It was also a really interesting conversation, and it just makes me more confident of holding a significant amount of my wealth in Bitcoin and hedging this potential inflationary issue that we're going to see over the next decade. So I hope you enjoy this one. If you have any feedback, you have any questions, you know you can reach out to me. My email address is hello@whatbitcoindid.com. And as I said earlier, I've got a new show that's just been released on Defiance, looking into Ghislaine Maxwell, who was the partner of disgraced financier Jeffrey Epstein. This first episode, we look into her father, her background, relationship with him. His name's Robert Maxwell. Now, if you're from the UK, you'll know him very well. He was a media mogul. But even researching this, there was a whole bunch of crazy shit about him I never knew. Honestly, it's a crazy story. Definitely worth checking out. You can find out that at defiance.news. And as I said, if you've got any questions, you can reach out to me. My email address is hello@whatbitcoindid.com. Hello, Lyn. How are you?
Hey, I'm good. Thanks for having me.
No, thank you for coming on. I've been a distant observer of some of your work recently, but it keeps popping up in my timeline. And then there was a very gushing tweet the other day from Nick Carter, which I don't. Did you see it?
I think I know. Yeah, I had a two podcasts with him. He's really sharp.
He's really sharp. He's been on the podcast a bunch of times. But he said, is there a clearer macro thinker than Lyn Alden today? Posted your article, and I read it. Took I think 2 sessions to go through it. And then obviously I wrote to you and said, hey, Lyn, I like this article. Can we talk about it? But I'm going to be honest. I was good for about 80%. And then about the last 20%, I got a bit lost. So
Sure.
we're going to cover that today. You okay with that?
Yep, absolutely.
Can I tell you what my summary kind of was from the article?
Sure.
My kind of reading between the lines of it all was the main problem that we have with the economy is politics and election cycles.
To some extent, well, it's because it's very short-term focused. It definitely doesn't help. Yeah.
Yeah, all the kind of interference and either kicking the can down the road or policy decisions with elections coming up. It feels like that's one of the biggest problems. Is that fair though?
I think that kind of gets down to that quote, like, democracy is the worst system except all the rest, right? So,
Yeah.
we have all the benefits of democracy, but yeah, one of the downsides is that, because we frequently elect our politicians, they're always optimizing for whatever their election term is. So that could be, depending on the particular branch, that could be 2 years, 4 years, 5 years, depending on where you are.
Yeah. It's funny you should say that. My brother keeps saying that to me because I keep going to him, telling him about Bitcoin and anarchism, and he was like, no, democracy is the best we have because everything else is worse. Was it Churchill who said that?
I think so.
It might have been. Yeah. Okay. Well, listen, look, I've got so many. You should see my other screen here. I've got so many questions for you. Right. Okay. So we're really going to go through your article step by step. Okay. So the big debate between fiscal and monetary policy, or or inflation versus deflation. But for like people listening who don't really understand how the economy works or how central banks and governments work, can you just explain what fiscal policy is, what monetary policy is, and how they differ?
Sure. So fiscal policy is what elected officials can do. So it's spending bills passed by Congress, signed by the president here in the U.S. Each system, of course, has their own different process for how that goes. But it's basically it's the the authority of the sovereign government to spend money into the economy, essentially. And it's also their tax policy. So it's how much taxes they remove from the economy. So it's things like how big their deficits are going to be. What kind of tax policies or spending policies they're going to have. Are they going to do, say infrastructure stimulus? Are they going to do tax cuts? Are they going to send out checks to everyone? That sort of thing. That's all kind of a fiscal decision. And then on the other side, monetary policy is what central banks do. So that includes controlling interest rates. That includes doing quantitative easing. And that can include buying other types of assets. So it's all kind of that tends to be it's mostly appointed officials. So in most countries, those central bankers are appointed by politicians, and so it's kind of off the public radar more so than whereas fiscal policy is more front and center.
Okay, and we couldn't be at a clearer time where the kind of work you're doing couldn't be more important. I've certainly only ever lived through 2 kind of economic crashes that really stand out. Obviously, the 2008 financial crisis. Was quite an interesting time because I bought a house about a month before it happened, and then it was perfect timing, and then obviously what we're going through right now with the pandemic, but they actually feel quite different in different ways. But your article is very interesting because you obviously wanted to look at the long-term cycles at play here and kind of look to history of what happened. But before we go into the long-term cycle, let's cover the short-term cycle first. You originally talked about the kind of 5 to 10 year credit cycles. Is this the traditional boom and bust that I study in economics?
Yeah, exactly. Yeah, it's this the way our system works is that it's people often describe it's like a forest fire. So you have a period of build up, and then you have a forest fire. You clear some stuff out, and then you build up again. And that's kind of the classic boom bust cycle. You start off the cycle. Businesses invest, people consume. You get more and more leverage building up, but then eventually it kind of hits like a euphoric stage. You have overinvestment, overconsumption, over leveraging, and then either it just kind of deflates naturally, right? A bubble can kind of pop for no reason, or you can have an external catalyst come along, and because the system's so fragile, it's easier to unravel at that point. So then you have a period of deleveraging, and you have classic recession. But then monetary policymakers come in, they cut interest rates, which makes it easy to refinance debt and take on more debt. And then usually fiscal policymakers, they often have inbuilt fiscal policies like unemployment insurance that are already kind of pre-decided. So they kick in, and then usually there's some sort of kind of a deliberate stimulus as well. It could be a little infrastructure stimulus. It could be an extra unemployment benefit, something to kind of kick the economy back into motion. And so that what that does is that usually that deleveraging event doesn't deleverage all the way, right? With the lower interest rates, you start from a higher leverage point, and then you start building up the next cycle from there. So over time, you kind of get higher and higher leverage in the system through business cycles, and that's what leads up to the longer term business cycle.
Is this all basically human greed?
Pretty much, yeah. I think our
Yeah.
natural tendency is to try to push things pretty much as far as they can go. So you don't just say, okay, we're going to look 10 years in advance and make sure leverage doesn't get this high. It's no, we're going to push it until it breaks, and then we're going to try to fix it as fast as possible, and then push it till it breaks again. And it's kind of, yeah, it's very rare to have kind of an economy that doesn't follow that approach.
Well, also there seems to be little reward for those who are a little bit more conservative with their money.
Yeah, there's kind of, I mean, it all depends. So, for example, businesses that have been classically conservative and countercyclical do get rewarded. Like for example, Warren Buffett has that famous approach where he tends to build up cash during when things are expensive, and then when things get cheap, he deploys that cash and kind of buys out businesses, and that's kind of helped. This has been an unusual cycle because when you reach the end of that cycle, if you get to the long-term debt cycle, it almost becomes that the people that were kind of countercyclical do get punished, right? Because you have kind of currency devaluation or bailouts that come kind of quicker for those that are struggling. So there's kind of a sweet spot. If you're struggling too much, you go bankrupt so fast you don't get helped. But if you're kind of in that middle ground where you're not really worse than anyone else, but you're just as bad as everyone else, that's when you kind of benefit from that bailout, because the bailout's kind of for the whole system.
All right. So another thing that really stood out to me, because you talked about 2008 and 2000, well, 2020, what's happening now, and obviously two cycles I've lived through. I experienced 2008, and it had an impact on myself and my family. In 2020, I'm watching it now, and I'm watching what's happening here. And what I couldn't figure out is, like, it felt like 2008 itself should or could have been the end of a long-term debt cycle, and it hasn't been. And I was trying to figure out through your article what the reason this is, and I got to the point where you talked about essentially you have international competitors now, and it's kind of a game of chicken. Who's gonna blink first? Should 2008 have been the end of a cycle itself?
I think they definitely could have done more at that point. One thing that I showed in the article is that the last time this long-term debt cycle played out, like in the 30s and 40s, they actually kind of had a two-period spike as well. So you had the banking crisis in the early 1930s, and then you had the fiscal crisis, and of course the war in the 40s. And whereas this time, we had the banking crisis in the 2008, 2009. And then it kind of spilled over into Europe in many places in the years after that, where they had that sovereign debt crisis and that banking crisis, and that was kind of stage one. And then now in 2020, we're kind of having that second part where actually it looks a lot more like the late 30s or the 1940s. Obviously without the war, but we have the pandemic, and we have the fiscal deficits that haven't been. We haven't seen deficits like this since the war. So in many ways, this is kind of the period after that banking
Mm.
crisis, right? So we already had, in some ways, a private deleveraging, in the sense that debt as a percentage of money supply has gone down from its all-time peak. So we kind of had the end of that cycle. However, now we're kind of in the sovereign phase of it. So we've pushed all that up to the sovereign level. One thing that's different compared to last time is that we by the time they did it last time in the 30s and 40s, they did deleverage the private system a little bit more. By the time they had that kind of sovereign debt bubble, whereas this time they've deleveraged it less compared to then. So we still have very high private leverage while we also have very high public leverage.
Right. Okay. I think we should go back a step. We should probably just work through what happens in these cycles, so people listening understand. Because I guess the goal of an interview like this, Lyn, is for me to get to the point where people fully understand what's happening in the economy, fully understand what's potentially coming, so they can help prepare for it. And kind of my summary from it is that some kind of devaluation is coming, likely inflationary, and therefore, yeah, it's a pretty good thing I hold Bitcoin, but I need to be prepared for that potential eventuality. Yeah, it might not be coming as soon as I think it is. That was kind of, it was almost like some people are expecting this to happen right now, but I think from reading the article, you were saying this is kind of like something that may happen across the whole decade.
It's usually a process, yeah. So,
Yeah.
I guess to go back to that short-term debt cycle thing, so those short-term cycles keep building up, and you keep building more and more leverage.
Hmm.
Usually, the end point to that kind of cycle is when interest rates reach zero, right? Because the central bank can't keep doing that process where they get lower and lower rates in each cycle. So they run into zero, and then they switch over to quantitative easing. So they create bank reserves to buy treasuries, mortgage-backed securities, sometimes other assets. And so then you kind of go into that route, but there's not a lot of kind of stimulus effort that the central bank alone can do at that point, and that's when it really shifts over to the fiscal side. So what makes the long-term debt cycle different than a short-term debt cycle is that there's so much debt in the system, and monetary policy pretty much runs out of ammo. And then it shifts over to the fiscal policy, and that's when you're more likely to get an inflationary outcome or a currency devaluation, which often go hand in hand. And so, as we go forward, kind of my premise is that, whether or not there's going to be inflation, or, well, eventually I think there will be, but the timing of that will largely depend on fiscal decisions. And so, for example, in the United States, we had a big fiscal boost in March, and then they were kind of expecting to have one in August, September, but they've been in gridlock, right? So now we're kind of
Hmm.
back in that more disinflationary period because there's not a lot of stimulus coming down that pike. And so if we look forward, uh, that's generally how these things play out. When you have so much debt in the system, we're at the zero bound, monetary policy is out of ammo. It comes down to kind of these massive deficits that the central bank monetizes, and then one of the outcomes is that sovereign bond yields remain, below the inflation rate generally for quite a long time. So you have that, anyone holding currency or bonds usually kind of loses purchasing power over a long period of time. And it can happen quickly, or it can happen gradually. And part of that depends on kind of some of the assets that that place has. If they have a lot of productive capacity, if they have a lot of financial assets, they can kind of have that play out more gradually. Whereas if you get kind of a bigger shock or a bigger system change, then yeah, you can have a very brief kind of inflationary outcome.
Is that by design? Do they keep bond rates below the inflation level by design, or is that a natural occurrence from what's happening in the economy?
Oh yeah, that's by design. So if you look at the 1940s, for example, which was the only other time, I often use the U.S. as my example, but this cycle plays out, throughout the developed world. And so in the United States, during World War II, we were running just absolutely massive deficits, and we brought debt to GDP up to over 100%. And what the Federal Reserve did was first they started buying some of the treasuries, right? Because there's so much treasuries issued that the private sector couldn't absorb it all. So they bought some. But then they also said, okay, we're going to lock interest rates for across the Treasury duration spectrum at 2.5% or less. So the short end was locked at like 0.38%, and the long end was locked at 2.5%. And so they pegged rates at a very low level. And then they defended that peg by saying, okay, every time that yields try to go above those levels, we'll just buy treasuries. We'll buy as many treasuries as we need with printed money, essentially, to keep that peg intact. And so in the 1940s, you had several inflation spikes, right? Because you're running very large deficits. You had a couple supply shocks here and there because you're kind of massing all this production for the war. And so you actually had certain years where inflation was higher than it was in the 70s. We all think of the 70s as the inflationary decade, but in the 40s, the cumulative inflation was almost as much, and it came in three kind of really big spikes. But if you look at the chart, treasury yields were still locked at 2.5%. So by the time the decade ended, anyone holding treasuries, of course, they got all their money back, they got their interest back, they made a nominal return, but they actually lost about a third of their purchasing power based on kind of standard measurements for that because their yields were not keeping up with inflation, and that was a specific decision by the central bank and the Treasury working together.
Right. Okay. And is that on old bonds they would have sold previously, or would they be selling new bonds and continuing that practice on? Because like, doesn't that create? Isn't there like a ratings agency that rates the creditworthiness of the bonds, and therefore these just sound like they're junk? Like, who would be buying this?
Well, yeah, it's definitely challenging because this time's going to be different. So back then, of course, you had a much less sophisticated kind of financial center around the bonds. You had less real-time information, so there kind of wasn't a lot of like widespread information about how
Right.
bad these
Okay.
bonds were.
No
But
internet.
Yeah, no internet. And to answer your question, it applied to all treasuries, right? So new, old, just say all 10-year treasuries were locked at 2.5% or less, and the Federal Reserve would print money as needed to buy those. Now, if you go forward to now, we're actually seeing that play out a little bit in certain countries. So Japan's doing yield curve control, Australia is doing yield curve control on their I think their 3-year treasury. And the Federal Reserve's been, they started talking about potentially doing yield curve control again in 2019, even before the pandemic. But then in early 2020, when we had they had to buy a ton of treasuries, we had that big liquidity crash. They've kind of revived discussions again about doing yield curve control. And they cited Japan, they cited Australia, and they cited the 1940s USA as different examples where that could play out. Now, the current kind of situation in Japan and Australia is that they don't have these big giant double-digit spikes in inflation, right? So it's not this egregious thing where inflation wants to be 10% and they're locking the yield at near zero. So it's currently kind of a subtle move on the market. It's kind of saying, okay, you might want to fluctuate a little bit, but we're not going to let you. We're gonna hold it down to this level. Uh, but if you do get kind of more and more fiscal, that could become more and more apparent.
Right. Okay. It's really confusing. I'm going to be honest. Like, for someone like me, I kind of look at this and I'm like, one of the things I like comes back to when I think about Lyn is like, is the economic system and the set of rules and that govern our economic system, are they themselves functionally broken? Do you look at it and do you think the entire economic system, the Keynesian way of doing things, is completely broken, or do you accept this is the only way to run an economy?
No, I think there are better ways to run it. I think the thing that's funny is that a lot of it is human nature. So some of it is that kind of specific decisions. But if we were kind of in a different system, we probably would have similar problems. But they might be more muted. They might be more counteracted by smarter policy. But for example, if you look back literally thousands of years in history, we have debt jubilees, for example, happen every few generations because it's kind of a natural tendency for wealth to build up and concentrate. And it's kind of natural to kind of build up debt until something kind of really forces you to deleverage. So these sort of things tend to be, partially linked to human nature. But then, yeah, I think specific policy choices can certainly exacerbate that rather than counteract it.
Yeah, because you had it in your articles at 600 BC in Athens, what was happening there, but it's mainly the social impact of wealth inequality, what happens, and I think I'd have to dig it out in your article, but it's a brilliant quote. But there was like a fear of here we've got it. The disparity of fortune between the rich and the poor had reached its height, so that the city seemed to be in a dangerous condition, and no other means for freeing it from disturbances seemed possible but despotic power. It's like, so you have to either head for tyranny or some form of kind of leveling the playing field. And do you know what it made me think of? I was in Santiago in Chile before the pandemic, and a very similar situation was happening there. There's a massive growth in wealth inequality, rising wealth inequality. They've had a change to their pension systems, which essentially screwed a whole bunch of people out of pensions, and they were seeing social unrest on the streets. And I think we're starting to see this social unrest spread into. I mean, we've seen it in Iraq, we've seen it in Lebanon, we've seen it in France. We're seeing it in the US. So there is a social impact of wealth inequality.
Yeah, absolutely. And in that same book that I cited, it's showing that basically, because that's from Lessons of History. It
I bought it.
Oh yeah, it's a really good book. It's like 100
Yeah.
pages. It's one of the yeah, it's a really good read. And one of the things that points out is that this is a pattern that does keep repeating. One way I describe it is that basically capital compounds exponentially, whereas labor compounds linearly, right? So in that kind of natural where that play out, as wealth tends to concentrate, it then tends to more easily keep concentrating. So you tend to get more and more concentration of that wealth into smaller and smaller hands, and that usually makes the economy kind of weaken because then you have the middle class is over leveraged and their incomes aren't going up, so you kind of have that stagnation. And you know every time you kind of get to that end of that long-term debt cycle, that's when the kind of society has a decision point. And so sometimes they do policies to try to counter that effect a little bit. So they try to do policies that help the middle class, the working class, and to kind of alleviate that. If they fail to do so, that's when sometimes you get outright revolutions, right? So if it's kind of like if they don't respond in a moderate manner, then they face, a more severe measure. And one of the way the books that describes it is that you can either kind of distribute wealth, kind of somewhat, or you can distribute poverty, which is if you kind of go the revolution route, usually no one wins really in that kind of route, at least for a long time.
Yeah. So do you think that's what's happening right now? So essentially we've got massive social unrest, especially what's happening in the US now, and we've seen like these BLM protests. I think a lot of us realize they aren't really about Black Lives Matters, especially when you start to see some of the more kind of Marxist rhetoric. Do you think this is a similar situation? Do you think this is what's happening? Because I think we also saw during I forget the report I read, but with the stimulus packages, the impact that actually had on wealth inequality itself, that saw just a massive rise in wealth inequality. So do you think that's what's playing out here right now?
Absolutely. I think that there's definitely an economic, kind of context or background behind some of this. And because, when people are happy, when people are kind of, things are going well, they tend to overlook some of the other issues. But then, when they're already economically suffering, when they can't work, when they feel like they're reliant on external forces that they can't control, then of course
Hmm.
they get more frustrated and things come out kind of, more violently or more even in terms of just peaceful protests, depending on different people, of course, do it in different ways. And I know you had Luke Groban on your show the other
Yeah,
week.
looks great.
Yeah, and I know the chart that he cited because I've cited it before too, which is basically that if you chart, in the United States, the middle class, kind of what percentage of their paycheck has to go towards essentials, right? So back in the 80s, it was like half their paycheck,
Mm.
whereas that kind of slowly got up over time until now. Incomes failed to keep pace with the growth of essential goods, especially healthcare. That's been a really big kind of contributor to the problem. And then by now, it's at the point where the median kind of male income no longer covers the essentials. And of course, that's when you get more and more kind of populism. You get more and more frustration. And then the challenging thing is that a lot of people don't know where to direct it. They don't know if they want to direct it at one political party, another political party. Do they want to direct it at immigrants? Do they want to direct it at China outsourcing? There's so many different paths that they could direct it to. They could, some people direct it entirely at the Fed, for example. Some people direct it entirely at the fiscal side, and it's very challenging for a lot of people to kind of break down what is the specific problem, where is it coming from, and where is the solution. So you kind of get all these different groups that are really polarized, and they all kind of have a different conception of what the problem is and how to fix it.
Okay. Can we point it at Steve Mnuchin?
I think you can definitely, he didn't start it, but he's definitely he's not. I wouldn't say he's helping it. This process has been in place for decades, but he's definitely one of the places where people can point to now and say that he's certainly not helping. And one thing, for example, in this particular crisis, just kind of the way that stimulus was structured in many countries, including the U.S. It's been kind of top down almost. So you had in some cases, people got stimulus checks, people got unemployment checks, whereas if, people running a small business often got kind of $1 million injections, right? And some of them didn't even need it. There were firms that were, pretty much unharmed by this, and then they get $1 million PPP loan that turns into a grant, right? So
I
it's kind of
know.
like, yeah.
I found out about that recently. These people, you don't actually have to pay them back.
Yeah, most of them don't get paid back, and they even said ahead of time that the ones under like 250,000 would barely be scrutinized at all. So some of the bigger ones, like the 2 to 5 million range, they would get a little bit of scrutiny to make sure there's no like outright fraud. But yeah, those loans essentially get forgiven as long as they met certain kind of they had to keep their existing number of employees on for like 3-4 months. They had to meet a couple kind of basic requirements, which especially if your business was not struggling in the first place, it was really easy to accomplish. So there are plenty of firms that didn't need them and still just got literally pure capital injection, and that goes right up to the top of the company, right? So the owners of that company kind of just they get that kind of $500,000, $1 million injection, depending on how big their company was.
Apart from that dude in Florida who got caught buying a Lamborghini. Did you see that?
I think I heard about that. I know that there was one I think there's one athlete that got caught, and there was like another business guy that got caught. I haven't tracked all of them, but
Yeah.
yeah, there's a couple of egregious cases that get flagged. But the more subtle case is just someone didn't break the rules, but their business didn't really need it, and there's no way to kind of prove their business didn't need it, and then they just get that injection, and they don't go out and buy a Lamborghini, and just it just never gets addressed.
Should have waited a couple of years to get that Lamborghini. He could have probably got away with it. But
Yeah.
it just feels like this system is just a big mess. It feels completely unfair. It doesn't seem to be rewarding the right people. Like I'm not an economist in any stretch of the imagination, but like it's really obvious to me that this. But then you know what, Lyn? Then I think, is this just systemic? Is this a problem that is like something you can't escape from if you're going to have an economy run on these models, which are, you're saying and happening all across the world in different countries? Is just a natural occurrence, or is there a fundamentally different way to run the economy? If we had a standard like the gold standard, would that make a difference?
Well, the gold standard was in place in the 1920s, for example, into the 30s, and that was broken
Okay.
because they, despite having the gold standard, they still were able to basically print money and have that kind of standard, kind of visible until kind of underneath the surface it was crumbling, right? So they kind of couldn't support it anymore, but it was still technically there. And then it kind of, when you get that big kind of banking crisis, it all kind of breaks at once, even though it really kind of broke gradually leading up to that point. You know, I, this sort of dichotomy comes up in multiple systems. So, for example, it used to come up more in aristocracy, obviously, right? So if there's centers of power that kind of they have wealth, and then that wealth gives them more access to political influence, right? And you kind of have that play out. If it gets too egregious, that's when you have like a revolution. So you happen in France, obviously, it happened in Russia. You have these kind of pushes against the aristocracy, and in today's system, in most developed countries, we don't have kind of that you either we don't have any aristocracy at all, or we don't have powerful aristocracy. But then you have kind of in place of that a crony form of capitalism. So instead
Yeah.
of kind of that healthy form of capitalism, you get kind of that build up, so that people that get more and more wealth can then influence politics more and more in their own favor. So it kind of accelerates that concentration, rather than kind of having a healthier system of kind of boom and bust. Or another way that I've seen described is kind of socialism for the rich and capitalism for the poor, which is one of the worst possible versions of that system. You want kind of a level playing field.
Yeah. Do you know Travis Kling?
I've heard of him.
Yeah, so he's been on my podcast a couple of times, and he said quantitative easing is universal basic income for rich people.
Yeah, pretty much. I mean, it does kind of play a role in boosting up asset prices. So a lot of people thought it would be inflationary outright, and it's not super inflationary outright, because it doesn't go through that fiscal route, and it doesn't really encourage banks to lend more. But it does seem to have a pretty strong effect for kind of reflating asset prices, at least to some extent.
Next up, I talked to Lyn more about Bitcoin economics and currency devaluations. But before that, I've got a message from my amazing sponsors. So let's talk about Kraken, my favorite place for buying and selling Bitcoin. The only place I use for buying and selling Bitcoin. And why? Well, they are consistently rated the best and most secure cryptocurrency exchange. And you know what? Security is really important to me. I've really upped my security practices recently, and using an exchange that really, really focuses on your security is the number one important thing for me. Outside of that, though, they also have the best in-class customer service. So whatever issue you have, if you reach out to them, they're going to get back to you, whoever you are, whatever that issue is. And if you want to start trading Bitcoin, they have every tool you could possibly need. Whatever your level of experience, it could not be easier to sign up at kraken.com and start trading Bitcoin. They also have this beautiful mobile first app. So if you want to trade Bitcoin on the go, if you're in Starbucks ordering a Frappuccino and you're thinking, I want some more Bitcoin, you can do that with Kraken Pro. And with margin trading, futures, and their OTC desk, Kraken has every option covered for you. There is no better place to trade Bitcoin. You can find out more at kraken.com or download the app. That's available for the iPhone and Android. Just search for Kraken Pro, which is KrakenPro. And lastly, but never least this week, is BlockFi, who are the future of Bitcoin and financial services. I am a customer. I am a customer of their interest accounts, and every month I receive interest on my Bitcoin. I love it. You can also become a customer. And not only do they have an interest account, you can use your Bitcoin as collateral and take out a USD loan. You can fund your BlockFi account directly from your Bitcoin wallet, and with the BlockFi mobile app, you can now fully manage your account on the go. With so much more coming this year, I know they're going to smash it. If you're interested in checking out BlockFi, I recommend you do your own research, then head over to blockfi.com, which is BLOCKFI.com. So do we have a new aristocracy here then, in where we have Wall Street infiltrating the White House, we have Goldman Sachs at the right hand of Mnuchin? Is this essentially the new aristocracy?
Yeah, I think if you have a sufficiently, kind of cronied up capitalism, it does start to kind of mimic a lot of the aspects of an aristocracy. It definitely can.
So we are going to have a revolution.
I think we're starting to see that play out. Have you ever read the book, The Fourth Turning?
Do you know what? Funny you should say that. No, I have it. I have it here. There's like about 3 or 4 books I have here where people keep saying to read. I've got The Sovereign Individual, I've got The Fourth Turning, and there's another one I've got. Go on, tell me why. You're the second person I think who's recommended that as well.
Yeah, so that was published in the 90s by 2 demographers, and one of them still active, Neil Howe, and so basically pointed out that roughly every 4 generations you have some sort of revolution, and that society kind of tends to go through these cycles where you have this big crisis, that's the fourth turning, and then starting with the first turning, like the next generation, you kind of have this period of unusual degree of kind of unity, right? So everyone experienced the chaos, and now they're all kind of unified. And if you're in the in-group, you benefit. If you're not, you kind of are suffering. But overall, most of the society is unified. And then you start to get that starts to fray a little bit over time. So of course, that unity is inherently kind of impermanent. And so over the second generation, the third generation, that starts to kind of fray. And then by the fourth generation, you tend up having like another crisis where you kind of those 80-year-old institutions are kind of torn down and rebuilt. And I don't think they spelled it out in the book, but if you look at the long-term debt cycle, in the United States and Europe, the long-term debt cycles were all fourth turnings. It's the same kind of pattern where whenever you have that really big kind of debt bubble, you have that wealth concentration. That's usually when the system is as structured for the past several decades is really no longer functioning, and they kind of grind to a halt. And that's when you have both economic kind of disruptions, but then kind of tied to that are the social disruptions.
Okay, sorry, just remind me, what was the first turning again?
So the first turning is like this period of unity, right? So everyone's kind of on the same board, and then the second is usually when there's a younger generation kind of pushing back against that to some extent. So that was in the U.S. That was kind of the 60s and 70s, right? So
yeah,
that was kind of
because the reason I asked what the first one was because if we're in the fourth turning now, if we're going to have a revolution, we've got a period of unity coming afterwards.
Yeah, but in their timeline, that's like a decade away or more.
Okay, well, I can still live through.
But I don't subscribe to the, it's one of those, it's just a framework to think about. It's kind of like, especially because I focus on the economic aspect more than somewhat more than the social aspect, and I kind of view the social aspect through the lens of an economic aspect, and just kind of observing that it's those cycles play out with the long-term debt cycle. So as you build up, society goes through this thing, they get fat and happy, but then that starts to kind of fray over time. You start to get more and more division, you kind of build up more and more debt, you keep pushing the can down the road, and eventually when you reach the zero bound of interest rates, when you kind of reach a really high level of wealth inequality, it kind of gets harder and harder to push it, it gets heavier and heavier, and then you get more and more populism, more and more kind of protests. And that's it starts to not only an economic cycle kind of starts anew, but then also it's kind of a new social framework usually that kind of accompanies that, because you had that all kind of come together.
Yeah, in your article, you had it in the charts. You pointed to the 2 times over the last decade where interest rates had hit the zero bound. We've started to see negative interest rates, which, to be honest, when they happened, I couldn't even get my head around understanding what that actually meant. But I kind of eventually did. Did we get negative interest rates the previous time?
No, we didn't. And I
So
think
this
there's
is
a couple
new.
reasons. Yeah, this is a new part of it. And I think there's a couple reasons. One is that, because financial instruments get more and more sophisticated over time, because the world gets more and more interconnected over time, it kind of is volatility is dampened to some extent, and that allows kind of a larger and larger debt accumulation. So we have kind of a higher level of debt now than we did in the previous, kind of long-term debt cycle peak. And then in addition, demographics are kind of a lot more slow growing now than, of course, they were back, 80 years ago. So when you have that kind of overall more deflationary forces, so there's all these kind of just the amount of debt in the system, and then kind of the weak population growth, weak consumption growth. It's by those two variables plus technology expansion are very deflationary. So then you have this
Okay.
big inflationary kind of response to that. But if it's not big enough, then yes, you kind of push rates negative.
So could we be in some kind of like super cycle now, like even bigger
Well,
cycle?
I think going back 80 years, I think an 80-year cycle's, a big enough cycle for me. I think, if you go back, that's already, I already think some people push back and say that's too far to look back, right? You can't look back at that far. So I don't know if I want to go back further than that, but, at the very least, we're kind of at an apex that you have to go back kind of 80 years in history books to see a similar kind of economic scenario.
Hold on, you went back 2,600 years at one point.
That's true. But it's not one giant cycle. It's more like showing how long these cycles have gone back in time.
I guess what that bit was the social aspect, the similarities in the social aspects, and the kind of rise in wealth inequality would have on the social unease within a city or within a country.
Yeah,
I guess
I love
humans are
that.
the same.
Yeah, I love that quote because you could literally, it's so like, it's kind of so applicable to today's society.
Mm,
You could put today's politician names right on that quote, and it would just play out the same way. And exchange, you could add like student loan forgiveness, like all the sorts of things they're talking about in that quote. Literally, just translate pretty much one for one for things that are kind of floating around today. It's the
all
same
right.
sort of cycle playing out.
Can we talk about the event horizon and why
Sure.
like 130%? Because you put like when debt to GDP hits 130%, that's essentially the debt event horizon. You can't escape now.
Yeah.
Is
Yeah.
that
It's
just like a historical thing, or is there a mathematical reason why you can't escape?
Well, it's kind of both. So that particular study was based on history that showed that over the past 200 years, whenever a sovereign reached over 130% of GDP, those debts were not paid back in real terms. So in some cases it was defaulted on. In other cases, it was kind of, it was paid back, but the currency it was paid back in was weaker. So it was basically you lost purchasing power. Uh, and and it showed that basically out of 52 cases that they looked at, 51 of them had that problem, and the one exception was Japan, because
Yeah.
Japan has kind of a lot of specific kind of attributes that kind of give it a lot of defense against this problem, and so they've kind of been able to elongate that issue more than pretty much any other economy has. So they're the world's largest creditor nation. For example, they own more foreign assets than foreigners own of their assets. They have a very kind of homogeneous culture. They're a very disciplined culture. And so they've been able to kind of pull the levers in such a way that they've been able to have a longer, they've been able to reach that debt level and then not have any kind of devaluation consequences from that for a much longer period of time than any other. But the mathematical aspect to it essentially is that once you get debt that high, the only way to pay it down nominally would basically be able to run surpluses for a while. But in most political systems, that becomes, kind of intolerable because you kind of get,
Yeah.
if you're kind of extracting surpluses from the system, then usually you get unrest at some point, right? So you get kind of an economic slowdown. You're not kind of juicing up the economy, and usually what happens is those people get voted out of office, and you bring in, the next round, and you kind of stimulate from there. For example.
Well,
So
I mean, in the UK, the austerity program over the last, I mean, was it decade under the Conservatives has been hugely unpopular. Now they've survived their re-election recently, but I guess if that had gone on for another decade, I don't think it would have lasted.
yeah,
Certainly, I don't know how traditionally it affects, but the austerity programs really were quite cruel and difficult kind of changes to policies that affected the most needy within society, which was shocking, really.
Yeah, they usually just don't last that long. And I think, it's one of those things in theory you could probably construct it in a way to work out, but just, with the imperfect systems that we all have, generally 130% is has been kind of the line in the sand where anything short of kind of like a perfect effort would pretty much fail at being able to nominally deleverage that.
And where are we now? What's the level we're at now?
Well, it depends on countries worldwide. So United
So
States went
the
over 100. We went over 130% this year. We went into this, we were already over 100%. So we're already kind of flirting with the event horizon. We went over 130%. Japan's a
okay.
special case because they're at like 200%. Europe varies. Each country's a little bit different, but Italy's pretty high. Obviously, they're one of the highest. Germany has kept it pretty low. The UK, they were a little bit behind the US, but they had a spike this year. Most countries did. So Europe's a little bit behind us there, but Europe in general has also a little bit more private debt. So, kind of if you look at Japan, Europe, and the United States, we're all in pretty much long-term debt cycle scenario where we have very high sovereign debts, very high private debts, and so usually these things are very difficult to deleverage nominally, and they usually end up experiencing currency devaluation, which in the mildest sense is yields being below the inflation rate for quite a while, and then in more aggressive scenarios can involve kind of a more inflationary outcome.
So you're basically saying, in all likelihood, we're heading towards a currency devaluation.
I think most
Most
likely.
likely.
I think that's going to be a scenario to kind of that plays out in the 2020s most likely.
Right, because essentially, if we base it on history, when other countries have done it, there's about a 2% chance it won't happen.
Yeah, and I also think it depends on the country you live in, right? So Japan, for example, has been able to push it longer than anyone thought, right? They have current account surpluses, they have the biggest net international investment position, they have a couple strengths they've been able to push that. So a lot of people kind of use that as an example and say, well, look at Japan, they got to this place and they didn't have problems for 2 decades, but each country kind of is a little bit different, and not Japan so far has been somewhat of an exceptional case. So I'd be somewhat surprised if most countries were able to kind of push this as far as Japan has.
But the only thing I always hear with regards to Japan is they've gone through a 2 decade period of stagnation.
Yeah,
Is this
yeah. I
because of
mean,
this?
well, I think that was a lot of factors. If you look at, so it's actually been about 3 decades. So their stock market peaked in 1989 and still
Oh,
hasn't
okay.
gone back to that high level. So if you look at their stock valuations back then, there was higher stock valuations for them in 1989 than in the dot-com bubble. And then in addition, their real estate valuations were higher than in the 2007, 2008 bubble. So it's kind of like they had a stock market bubble and a real estate bubble that were both absolutely bigger even than the 2000 and 2007 periods and at the same time. So that was one of
Okay.
the biggest ever bubbles in history. So that's been deleveraging for 30 years. Now part of it was leverage and part of it was a sheer overvaluation. So that just inherently takes a long time to play out. So you know, but and but then in addition, they have their super slow demographics. So they have a very older society. They have a very, at this point, their population's outright shrinking. So that definitely also contributed to, especially nominal GDPs just not going up a ton because it's kind of in a more steady state.
Right. Okay. So how does so you cover this? This is where I got to kind of like got a bit sticky within your article. I followed most of it through, but when you got to the kind of towards the end, started to explain how a currency devaluation looks like. Can you just talk me through that so I can understand?
Sure. And I think we can use the US as an example because we've had three major devaluations in the past century. So the first one in the 1930s was the gold peg devaluation. And this is what most developed countries went through at that time. So they all kind of depegged their currency and repegged it at a lower rate. So in the United States, gold was about, $20 for an ounce of gold, and then it was devalued for $35 for an ounce of gold, right? So it was cut pretty dramatically. And what that allowed them to do essentially was print a lot more money and still be able to back that by the amount of gold that they had. So in the United States, that was not very inflationary because it was going up against a very deflationary force of all that debt. So that moment of the gold peg devaluation was when outright deflation shifted to inflation, but it wasn't very high inflation, right? So that whole kind of 1930s decade was not very inflationary, but it was kind of a devaluation relative to gold. And that's one example. And then there are different charts that show kind of each currency depegged versus gold at a different rate. So Switzerland, for example, held up a little bit better. The dollar went down pretty far, and then several of the other European currencies went down further than the dollar relative to the gold peg that they had. So, and then in the 1940s, that's when we had the more inflationary devaluation. So that's what we talked about before, where we had kind of spikes of double-digit inflation, but they held treasury yields at 2.5% or less. So anyone holding treasuries, you got all your money back, but dollars, the money supply went up dramatically in that decade. Prices of everything went up dramatically in that decade, but the amount of debt you're getting back, like the interest rate and everything is fixed, right? So you're
Hmm.
buying fewer goods with the money you're getting back. So that's an inflationary devaluation in the sense you have high inflation and interest rates are not kind of keeping up with that. So that's another example. And then the third one was in the 1970s. That was kind of a weird case because it wasn't a long-term debt cycle period, but basically it was a couple of different variables, high deficits, kind of a change in the global monetary system away from the Bretton Woods system. So a couple kind of factors came together, and so we had very high persistent inflation in the U.S. and most of the developed world. And even though you didn't have yield curve control, yields just rose more slowly than inflation. So you had these kind of a couple periods where you had big spikes in inflation, and so yields caught up more slowly. So again, if you're holding treasuries or other sovereign debt, you got all your money back, but by the time you got it back, you could buy fewer goods and services with it. And so those three periods all were kind of faster than normal, broad money supply increases, just a lot more currency units in the system, and those currency units buying fewer goods and services.
And do you think this is how it's? Do you think this is how it will play out this time again?
I think so. I think that, at the very least, I think that real yields are going to be negative for quite a while, meaning that, anyone holding kind of sovereign debt or cash in the bank, any sort of yield you get, which even if it's marginally positive like we have in the US, is unlikely to keep up with inflation. And so it's not even keeping up with reported inflation, and then underlying real inflation for many people is probably higher than the reported inflation. So kind of that super low, kind of zero level interest rates. If you're basically holding treasuries or holding cash over a 10-year period, you're by the time you get all that back, you buy fewer goods and services with it. Whereas normally we think of treasuries or putting money in the bank as something that grows our wealth, but that's very unlikely to play out, in this decade.
Do you think we could see double-digit inflation, annual inflation within, say, the US market? I know they're seeing it in Turkey right now. I think it's like 12%. Do you think you could actually see that in the US?
I think it's possible. I think it's hard to do because one difference is that countries that borrow in currencies that they don't print, which
Right.
emerging markets like Turkey, Argentina, they tend to have more inflationary outcomes because their obligations, their liabilities are priced in a currency they can't print, so they can't
Right.
kind of devalue their debt. Whereas developed countries, most of their debt is denominated in their own currencies, so they have more kind of levers they can pull to make things happen more gradually.
Hmm.
But then there's always kind of disruptions to that kind of plan. So everyone has a plan until kind of reality comes. So I think from a policymaker standpoint, they want to have it be very gradual. They want, for example, inflation to run at 3-4% while they're holding yields at 1 or 2%, and so you kind of get that gradual currency devaluation over time. Whereas it's very possible that if you get a supply shock, or you get some sort of major social unrest, or something that makes it so that the supply of goods and services in the system are not keeping up with that printed money, then you can definitely get kind of a double digit spike. Another
Like a
example would be
like a pandemic.
like a pandemic. Yeah, well, for
Yeah.
for example, we've seen grocery price inflation. Most of it hasn't reached double digits. A couple categories have, but most of it, we've seen kind of 3, 4, 5% inflation in groceries because we've our supply chain's not super flexible. So the supply chains that give foods to restaurants, for example, can't be quickly converted to put those same foods towards grocery, supermarkets.
Mm.
So when we've all kind of consumed far less from restaurants and consumed far more from groceries, that's resulted in some supply shocks and some price increases.
Yeah. Okay. So basically, what you're saying to me is, Pete, holding cash over the next 10 years in the bank is kind of risky.
I think so. Yeah, I view treasuries
Yeah.
and cash in the bank as risky. And I still, it doesn't mean I hold a zero amount because I hold it for liquidity. And then I
Hmm.
also, to some extent, hold it for counter-cyclical investing. So if we get a big dip in any of the assets I like, I can take some of that and kind of deploy that. If we get kind of a brief kind of, surge where something goes up way faster than I thought, I can take a few chips off the table. But other than cases like that, there's not a super compelling reason to just put a lot of money in the bank or into sovereign debt and then hope that over the next decade that keeps its purchasing power.
Okay, so let me then just switch a gear with you a second. What's your Bitcoin thesis? Like, how much are you interested in Bitcoin? How much do you know? Obviously, if you've been listening to my show, you care a bit, but what's your own personal thesis with it?
So I'm bullish on it. So
Okay.
I I first covered it in writing back in 2017 because it was having that big kind of surge, and I was getting all these
Hmm.
emails from people like, "Hey, can you cover Bitcoin?" So I wrote this article on Bitcoin, and my view at the time, because that came out in like autumn of 2017, I was like, "It's really overbought." I analyzed it from a couple different perspectives. Like I analyzed it both as a medium of exchange and as a store of value. And as a medium of exchange, I considered it overvalued, but as a store of value, I thought it had a lot of potential. But that at the current price, I just wasn't interested. So I kind of just said, there's a lot of risk here. If you want to put, 1%, that's fine. But I wouldn't go overboard at these prices. And of course, we next few months we got that big kind of surge to like 20,000. Then we got the collapse to like 3 or 4,000, and we've been in this kind of 2-year, 3-year consolidation. Now, in April of this year, it was back around the same price as when I analyzed it in 2017. So it was like in the kind of the six to 7,000 range, and that's when I turned bullish on it. So in my research service, I went bullish on it, and then I published a public article in June on it, kind of outlining all the reasons why I'm pretty bullish on it now, especially in this point in the halving cycle. And so you have kind of that macro backdrop that I just described, where you have
Hmm.
yeah, persistently negative real yields, probably potentially a degree of quicker currency devaluation in some scenarios. Meanwhile, there are assets like gold and Bitcoin that are these scarce assets that even though they don't pay a yield in many cases, they're scarce, so they can hold their value against kind of more and more kind of fiat currency being printed. So that's been kind of my main thesis that especially in this part of the halving cycle, there's a pretty asymmetric reward for holding Bitcoin.
Right. Okay. So you're in.
I'm in, yeah, since April.
You're in. Wow. Okay, that's pretty cool. I moved my so essentially my Bitcoin podcast is a little media company, but it holds cash reserves. Is a profitable business, and I moved to 60% Bitcoin position because I have no need to spend these cash reserves over the next at least 12 months, maybe longer. And I was really nervous about holding cash reserves, so I went 60%. I would say I did a very small version of what MicroStrategy did. I'm assuming you followed
Yeah.
their news. What did you make of
Yep.
that?
Well, it's interesting. So when they did that, I actually bought a small amount to kind of convince myself to keep following it, and because some of my portfolios that I kind of track for people, I was like, that's actually a way to get slight indirect Bitcoin exposure in those portfolios. So, but I've been following that a little bit. Basically, that's a company that was extraordinarily cash rich. So they had over
Mm.
$500 million in cash. They used to have a period of fast growth, but in the past few years they weren't really growing. But they had that really good asset of no debt and tons of cash. And so, imagine being just so your biggest asset is how much cash you have, and then you start to read about kind of negative rates or yield curve control or inflation or any of these things. And so, he clearly did a ton of research. I actually found it interesting because he had a couple different interviews recently, and he mentioned that he sent my Bitcoin article to his board of directors. So
Nice.
he actually read that Bitcoin article. That was kind of one of the pieces that he looked at. So it's kind of full loop. He read my article, but then I invested in his company. So I think his is clearly a really big play. I mean, I would not have been surprised to see some companies put, say, 5-10% of their cash in a Bitcoin, but the fact that he put literally like all of his cash in a Bitcoin was definitely pretty surprising. And I think one of the kind of the underlying things is that now because they don't have a Bitcoin ETF, right? So the closest thing they have is like the Grayscale Trust,
Mm.
which is trades over the counter. But now you have a Nasdaq listed security that is like the 1/3 of the market cap is Bitcoin. So you know, is kind of like an indirect Bitcoin ETF, because any fund manager, like let's say their mandate is they can only invest in stocks. Well, now if that manager wants to have a Bitcoin exposure, he can say, well, I'm just buying the stock. I think it's a good software company. I want to buy it. But really, what he's doing is he's getting Bitcoin exposure. So it's kind of like he's turned his company into this
An
kind of hybrid
ETF.
security. Yeah, pretty much.
Madness. Yeah, because I look at other companies. I mean, yeah, I think it's everyone always thinks of Apple. I mean, I don't know what their cash reserves are now. Is it like 120 billion or something insane? But
Something like that. Yeah.
yeah, but as a company, they will be facing over the next decade potentially losing a very significant. Well, we talk in purchasing power, but the value of that money. I wonder what a company like that is even considering doing.
Well, I think they're a little bit less vulnerable because so with Apple's case, they actually have a lot of debt to go along with their cash, and so they've kind of levered themselves up for share purchases. So they issue really cheap debt, and of course they have one of the highest credit ratings in the world, Apple. So they
Right.
can borrow at extraordinarily low rates. So their balance sheet has a ton of cash and then a ton of debt. Although the debt is not that high relative to their incomes and everything. But in terms of just because the company's so big, they have a pretty good amount of debt. So it's kind of like someone that say has a lot of cash, but then also has a fixed rate mortgage, right? So it's if you were to get that kind of cash devaluation scenario, Apple's kind of more balanced to that because their debts get kind of devalued, but then also some of their assets get devalued. Whereas MicroStrategy had no debt and tons of cash, so a currency devaluation scenario for them is all bad. And there are a
Right.
couple of
Okay.
companies, and there are companies like Google and Facebook that are in this same scenario as MicroStrategy, where they don't have the debt, they just have tons and tons and tons of cash. So they're actually kind of, vulnerable in the same way that MicroStrategy was. They don't have cash as the same percentage of their market cap that MicroStrategy had. I mean, their cash relative to the size of the company was absolutely massive. But there are these other companies that have, tens of billions of dollars in cash and T-bills sitting on their bank, on their balance sheet, and they don't have the liabilities to kind of offset that. So yeah, they're vulnerable.
So is it then therefore a good time right now to take out debt?
I think it could be a time to take out debt responsibly. I mean, I
Yeah.
would never encourage people to take on unnecessary leverage. I mean, it's not I don't think it's a bad time to have a fixed rate mortgage on an appropriate property, for example. If I was running a company, I would have a non-zero amount of debt. I would
Right.
have, a strong balance sheet, but I probably wouldn't have zero debt.
Interesting. I don't know what I could take debt out for in a three-man podcast business, but maybe that Lamborghini. Okay, so listen, just to finish out, a couple of things. If you are just a normal person like myself, just like trying to figure out day by day how to get by, I want to pay my mortgage. I don't want to be broke. I've got a little bit of cash savings. I own a few assets. What should I be preparing for over the next decade?
I think there's a couple of things. One is, kind of diversifying income sources as much as possible. So either, people have their main income from their job usually, but any sort of side hustle they can do or develop their own skills so they can have kind of multiple sources of income. If it's a family, so there's two people in the family, and they can, if they both have an income, they can try to make it so that their expenses are low enough that if they were to lose one of the incomes, the other income can still cover all their core expenses, right? So the other income is kind of for saving and fun, right? So they
Hmm.
kind of made themselves anti-fragile. They can diversify the types of assets they hold, right? So they can have, some global equities, they can have Bitcoin, they can have precious metals, they can have their own house, whatever the case may be that makes sense for them, to have kind of a diversified assets with an emphasis on things that are scarce. And then, if they have debt, just to make sure that they're not over leveraged, right? Because you don't want to have a ton of debt and then lose your income and not be able to support that debt and have to kind of sell those assets kind of at an inopportune time. But for example, certain fixed rate mortgages make a lot of sense for people, things like that.
Okay, brilliant. All right, well, listen, this has been great. Something Luke said to me that stuck with me is that you should consider your portfolio in terms of cash, property, equities, and scarce assets, and try and rebalance over time, which is something I've never done, and I've started to do that. I would say I'm a highly leveraged with Bitcoin right now, and I'm trying to get rid of my cash and thinking about a second property. It's yeah, difficult times to try and like navigate if you're not economically trained like myself. Your blog is utterly fantastic, and I'm subscribed. Tell people where to follow you, though, Lyn.
So I run lynalden.com, so I have a lot of free stuff there. And then I'm also on Twitter at Lyn Alden Contact.
Okay. What is the day gig? Like, are you a consultant?
Well, my website is mainly like the research service.
Okay.
So I have that kind of the premium thing on the side.
Right.
My long-term background has actually been in engineering and kind of engineering management.
Right. I didn't see the premium thing. It did stand out to me. Tell me about the premium service.
So most of my free stuff, for example, the free newsletter comes out every 6 weeks, whereas the premium service, I report every 2 weeks and sometimes more often. And kind of real-time portfolios, things like that.
You don't push the premium enough. I didn't even see that. Just hidden there
Yeah,
in the navigation.
Yeah, I don't do like aggressive advertising.
It's only $200 a year. Come on.
Yeah.
I can afford that. I'm going to sign up now. I'm going to do it. Listen, Lyn, thanks for coming on. This has been great, really useful for me, and I'm glad you're into the Bitcoin thing as well. Good luck with everything you do.
Yep, and thanks for having me. And I really enjoy your podcast. It definitely helps educate people. I came across a couple of your episodes, and if there's ever like an angle that I don't get, you like in your archives, you usually have like a podcast where you brought on like the exact right person to discuss it. So
somebody,
it's really great.
Do you actually use the archive? Like, because there's an archive up on my website, and it's got it by like category and by guest. Are you the one user of that archive?
No, I just, for example, will search on YouTube or something like that and just be like, say there's a specific thing I'm looking for and it's like such and such Bitcoin. I just type it in, and often like your podcast would come up because you had like the guest talking about that.
Brilliant. Okay, that's fantastic. All right, well, listen, I'm going to sign up to your website now. I'm going to get the premium service, but thanks for coming on. I'm sure we will do this again, and good luck with everything.
Yep, thanks for having me.
All right. What do you think of that? Did you enjoy listening to Lyn? Did you enjoy having her on the show? Now, a lot of the things that she talks about are really bullish for Bitcoin. If we do see a currency devaluation over the next decade, holding a scarce asset is surely a good thing. However, it does sound like it could be catastrophic for a lot of people, so it's kind of weird. Sometimes it makes it hard to get excited about. I obviously haven't lived through a hard currency devaluation in the UK. The inflationary impact upon the pound has been rather, it's more slow and insidious. You just gradually see the price of a pint of beer going up. But we do have the potential of seeing this kind of hard and significant devaluation over the next decade. And having watched the impacts of a currency collapse in countries like Lebanon and Turkey, I can see how inflation really, really impacts people. So anyway, I am confident that holding Bitcoin is a good thing, but as I said, I'm trying not to get too excited about it because I don't want to see this kind of negative impact that happens to other people. Anyway, I love talking to Lyn. Her perspective is really interesting. I will definitely try and have her on the show again in the future. And as I said in the intro, I do highly recommend signing up for her premium service. Links for that are in the show notes. And as I always say, if you've got any questions, you can reach out to me. I do receive a bunch of emails a week. I do try and reply to everyone. And my email address is hello@whatbitcoindid.com. Also, if you want to support the show, really, one of the best things you can do for me is just go up to iTunes and leave a review. If you enjoy the show, it takes about 2 minutes. Hopefully you think it deserves 5 stars, but whatever I deserve, it really is helpful. It helps with the rankings. Outside of that, as I mentioned in the intro, I've got this fascinating new series that has just started on my other podcast, Defiance. It's all about Ghislaine Maxwell. She was the girlfriend of disgraced financier Jeffrey Epstein. In this first part, we look into her background, into her childhood, and mainly her father, Robert Maxwell, who, if you are from the UK, you know who this guy is. He was a flamboyant media mogul who ended up dying in suspicious circumstances himself. So it's going to be a fascinating story. You can check that out at defiance.news. And as I said, outside of that, if you want to reach out to me, my email address is hello@whatbitcoindid.com.